Hello, thank you for joining us for today's webinar. I'm your presenter today. My name is Dave Mantell. I'm a certified financial planner and a partner advisor at Stabler Wealth Management. And so for today's Boeing webinar series, we're going to be covering a topic that's surely on everyone's mind, which is investing for retirement during uncertain times. It's always challenging enough going through years like 2022 in the market, not to mention all the recession concerns and other issues out there currently, especially uncomfortable right ahead of retiring or in those early years in retirement. And so today we'll cover how to manage these types of environments with your investment portfolio as you're approaching that big retirement date. The presentation today will be primarily focused on those within 3 years of retirement that work for Boeing. However, we'll be covering a lot of great content. So for someone further out than 3 years, please stay. There'll be a lot of great information to cover there as well. And yeah, really my hope is by the end of the presentation, you'll have a good idea and a roadmap in terms of how to think about your investments as you approach that retirement date and any possible changes you might consider for your own investment portfolio. All right, well, with that, let's jump in. Okay, so as noted, investing for retirement during uncertain times. And so our agenda today, we're going to break into 3 main parts. We'll kick off going over the importance of personalizing your investments to your own retirement plan. There's a lot of target date retirement funds out there and publications about when you're retired, you should be this way or that. But really everyone's circumstance is different. So we'll share some feedback and thoughts on how to make your investments match your own goals and situation. We will then cover having an all-weather investment portfolio, which is very critical with all the environment and background that we're going through and changes in the market and economy. And then lastly, a favorite topic of ours is investment strategies for tax management. Anyone who's been attending our webinars, as you know, we bring up taxes a lot, but it is such a huge component of what your actual wealth is that hits your wallet, hits your bank account, and it's something that you have control over. So it's absolutely critical that we're dialed in and maximizing that. As we can't tell you what the stock market's going to do in 2023. No one has that crystal ball, but we can manage strategies that we know are going to contribute to more favorable taxes for you, both in the short and long term. Any questions throughout the presentation, fire us an email at info@stablerwm.com, WM as in wealth management, so stablerwm.com, and we will make sure to address those questions and follow up with you on any items that we don't cover in the presentation. And then, one more slide before we jump in. So a little bit about us. So we are a team of certified financial planners, and we really specialize in working with Boeing professionals as they prepare for and transition to, and then ultimately succeed in retirement. And so that's really what we focus on. And, what we like to really dial in on is personalized service and care, that's specific to each of our clients that helps you drive better outcomes. And that could be a combination of, getting the return you should on your investments and the right amount of risk, managing and minimizing your taxes, making sure your financial plan aligns with your retirement income plan and estate plan, and everything's rolling in the same direction. And so we really serve as a financial partner in terms of making those things happen while looking to hit your goals, have a track towards that, and provide you with peace of mind. We will make sure to record this webinar as we do for all our webinars and put on our website. And so you could get the short link to the Boeing page at www.planyourboeingretirement.com. There's also a button on there to contact us. So if rather than email, it's easier to click on the button and hit our contact form, please do that at any point in the presentation. All right, so with that, let's roll up our sleeves and dive in. To set the table, I don't need to mention it to any of you. We are going through uncertain times right now. Coming off of the worst stock market last year since 2008, the worst balance market for a balanced retirement portfolio going back to the 1930s, in which the stock market dropped nearly 20%. And really, bond investments, real estate, most asset classes really struggled last year. On top of that, the Fed raised rates again this past month, right? And so we are still in a rate hike regime, one of the fastest on record. And while there's an expectation that they're going to start cutting rates at some point, time will tell. We're not there yet, and there's a lot of uncertainty surrounding that. And while inflation has come down from the highs that we saw, mid last year, the highest inflation numbers in 40 plus years, it's still over 6% or in that range, which is, essentially more than double the target. So while we've seen some improvement in inflation, by no means is it mission accomplished at this point. So a lot of uncertainty there. Not to mention, we're seeing some bank failures. Seems like every week, more and more banks are coming out with issues and solvency issues, really showing some cracks in the economy. This past quarter, we had, negative earnings from the prior period. And so expected further earnings weakness, a lot of talk about recession. And to top it all off, we got a lot of geopolitical tension going on, right? Still Russia-Ukraine issues, concerns with China. And so, this is sort of the top items that come up the most, but there's a lot to be concerned about. At the same time, we are a glass half full group over here. And while these are worries, there's always worries. We've been through bear markets and recessions and inflation and deflation. So every time is a bit different. This does not mean we're all doomed by any means. It's just important to have an idea of what the environment that we're in is, what tools work best in this environment, and just really have our eyes wide open so we know how to best navigate. But, again, for example, while last year was a tough year, historically speaking, once you come off years like that, the next 3 to 5 to 7 are typically better. We'll see this time what the outcome is. But it is good to, again, highlight what the environment is out there. And, that really drives a lot of things that we should be thinking about and really positioning our portfolios to adjust for. Okay, so on the agenda page, I noted, first off, so critical to personalize your investments to your own retirement picture. Your situation is different from, Nancy in the desk next door or John down the hall. So everyone's portfolio should be specified based on their needs, their family situation, what their goals in retirement are, what their long-term goals are, if it's important to, pass on money to heirs, for example. Everyone has different situations, and therefore everyone's portfolio should really look different to the extent it should be matched to your own specific time horizons. And so, especially as you get closer to retirement, it's really critical to have that personalized touch on your investments, rather than, in our view, say, hey, if I'm retiring in this date, I should be invested this way, right? Or if I want moderate risk, I should be invested this way. We really want to specify to your own situation. And, that's something that we really do and focus on for clients as a firm. And so when aligning your investments to your retirement income plan, the way to think about it is, again, matching your horizons for your investment to when the funds are needed. And so when you move into retirement, there's a few components. So you're going to have Social Security come in on some point. For those of you taking the pension rather than the lump sum, you're going to have pension income at retirement. And then in addition, you're going to be drawing money from your 401k and other investment accounts, which is why you saved all this money over the years. And so as you map out your retirement income plan, there's going to be certain cash needs in certain years, and you want to make sure you're investing specific to those needs. And so, short to medium term money, for example, should be invested differently than longer term money. And I'd say the most, one easy example or way to think about this is, if you need to fix your roof next year and it's going to cost you $20,000, you should not put that in a high risk technology stock fund, those funds, right? You want it in something more steady that is going to be there when you need it. Same thing with retirement income. Money that you need in the next 1, 2, 5, as many as 7 to 10 years, depending on your risk tolerance, you do not want that short to medium term money in high risk investments. That's a mismatch. That should be your more steady Eddie investments. And then for money that you don't need for 8 or 10 or 15 plus years, it could be more risky to be too conservative because you're not going to keep up with inflation, right? And so that should be more growth oriented. And so again, this is what we're referencing, same way that big companies do their financials and forecasting, or insurance companies, is we need to figure out when the cash flow needs are and match your investment to that accordingly. And this is critical. Someone may be in a position where they have enough in savings, they're able to take a really modest retirement withdrawal, but if they're invested too conservatively or too aggressively, they may come off the rails and come off track and not have a successful financial retirement, even though they had done the work to get up to that point. And so, especially when you're taking money out, it's just a totally different animal than when you're saving and putting money in. And so that is a time to have a retirement income plan and an investment strategy that matches that specific to your picture. So when we look at risk with your investment portfolio as you approach retirement, really the top risk in our view that we see commonly is that sequence of returns risk. And basically what that means is that if you retire, and let's just say those early years of retirement, you hit a string of down market years. For example, 2000 through 2002 were really difficult years. That could be a really tough thing to come back from if you do not have a concise plan and you're invested too aggressively or inappropriately. And really, the whole name of the game is we want to avoid being forced to sell your growth investments at a down price. We want to buy low, sell high. We do not want to sell low, buy high, right? Is what it comes down to. And so that's the way to think about sequence of return risk. And here's a great example. So if you look at the period from 2000 to 2015, it was a whopper, right? 2000 through 2002, like I noted, was a really tough 3-year stretch. The market climbed back, up to 2007, right before 2008, right? And sort of reclaimed where it was that decade earlier. But then 2008 happened and we saw, a real, devastating market drop, really within a decade of the 2000 bear market. And so lo and behold, if you look at that second red circle in the middle of the page, you could see at 2009 trough, the market was, much lower than it was, 9+ years earlier still. And so here you are 9 years into the market and you are down dramatically from where you were 9 years ago. Plus you're taking draws out on top of that. The market did turn and recover strongly, right? From 2009 bottoms, up until really 2020, it powered to a 4 times plus return. And so if you look at this, stretch from a, 15-year longer term view, it did recover. But for those that were allocated incorrectly and did not have a good retirement income investment plan, you really could have been devastated and not recovered from this, right? And so that's why when you're taking withdrawals from retirement, how to take your retirement withdrawals, how to refill and rebalance your portfolio, refill those safe buckets opportunistically is, a huge part of the deal to having successful retirement income. And so, for example, when we do retirement draws from clients, we have that earmarked, more steady Eddie piece of your portfolio with those more safer, conservative investments. And that's where you're taking your draws from. That way, if you're facing a 2008 market drop, you are not forced to sell your stocks low, right? You have time horizon for those to recover, and you instead are pulling from your more conservative investments. And then we have the ability to decide, okay, when do we rebalance, so we could, either rebuy stocks low or, sell stocks high. And then when do we refill those, more conservative buckets and do so in an opportunistically way? One challenge with the 401k at Boeing is when you take withdrawals, they do it pro rata. You can't decide, I want my withdrawals from a stable value fund or bond index fund. It comes from a blend. But for an outside retirement account like an IRA or brokerage account, you can absolutely specify where you're taking your withdrawals from, what investments, and that gives you a lot of flexibility to manage that sequence of return risk, right? And so again, going to the charts, if you look at this period from 2000 to 2015, the green to green, the market, hey, was positive, decently over that stretch, but the year to year was a very different example. And so really in the red, you do not want to be selling your stock funds, right? Those green circles throughout, that's where you want to be repositioning those. And so having a real more intentional touch there makes a big difference in retirement income planning. Okay, so I know I painted a scary picture of a stock market, but again, over the long term, stocks in our view are the number one wealth builder. We really believe that, but the key is matching those to the right time horizons. And so in addition to that income oriented component of your portfolio for the more short to midterm, it's just as important to have growth oriented stock fund investments for that longer term period, which are going to grow, keep up with inflation, replace the draws that you're taking out. And so that's really critical. And while stocks can be really volatile in the short to midterm, over the longer term, that crystal ball gets a little bit more clear and you're able to enjoy the benefits of having longer term stock investments and what that will do and drive your wealth over time. Again, to both maintain your principal and keep up with inflation. And, I think something really critical is that, for couples that are over the age of 60, more than half, at least one spouse is going to live beyond the age of 90. And so for someone retiring from Boeing at 57 or 58 or 60, that's 30 plus years of living, that you need to be prepared for. And as we've seen with inflation really raging, a hamburger is going to cost a lot more, a tank of gas in 30 years than it does today. And so that's why it's important to have that combination and overlay between your income investments for that more short to medium term and the growth investments that are going to keep that, growth, refill your draws, keep up with inflation over the longer term period. And so, when working with clients on their investment portfolio, this is just one that you have to get right. And it's different for everyone's circumstance. And so, again, it's finding that intersection between how much growth do I need and how much balance, how much conservative, with what allows you to sleep well at night. And so this is one where I really recommend, honestly, reach out to our team. I'm going to go over at the end of the session. We're offering a complimentary review, to anyone who joined this webinar. But yeah, talk to a CFP, certified financial planner, talk to a professional to get an opinion on how you should be allocated to hit your goals, as well as be within your comfort zone. Because finding that intersection is really the critical piece there. And so for those of you, so let's say you meet with our office and, we go over, hey, we strongly suggest you maybe you're too growth allocated or too conservatively allocated. We have some real thoughts on how to best adjust your portfolio. So first things first is, if you have too much stock exposure, let's say you're planning on retiring in the next year or 2 years and you're fully in stock, you have everything in that growth bucket. So in that slide I showed earlier, if we see a market fall off, you're going to be forced to sell your investments at a low, right? Sell your stocks at a low. And so if you're over allocated stock exposure, we do think that's one that's important to address right away. Because as we've seen in these volatile times, the market could really, go one direction or the other in a hurry. You don't have the luxury of waiting on that. And so in addition to reallocating your current investments, another thing you can do is evaluate your future contributions. So money that you're saving, contributing your 401k, for example. And so that might allow you to say, hey, okay, let's make an adjustment right away to get to kind of a minimal comfort zone and how much should be in that more conservative bucket. But also in our next 2 years of working, as we save money, maybe we'll add that to the conservative bucket so we don't have to drastically sell our stocks right now, right? And so that could be a combination. But again, if you're over allocated or too risky investments, that's one we do recommend not waiting on. You'll want to address right away. If you are under allocated to stock exposure and too conservative, that's one that we could come up with a plan on how to allocate to. Because again, with investing, it's a marathon, it's not a sprint, right? And so the goal is, again, good chance you or your spouse are going to live to 90. We want to make sure that you have the tools and success over the next 30 years to hit your goals. And so if it may be uncomfortable to say, oh my gosh, I got to move several hundred thousand into stock investments, I'm nervous to do that right now at once because what if the market drops tomorrow? That's a direction where we could do it more in stages. A good way to do that is called a dollar cost average approach, where if we identify, we recommend, adding 200,000 more to your growth bucket. Maybe we do that in $40,000, increments, right, over the next 4 or 5 months, for example. And that way it will, kind of reduce, the uneasiness or nerves or gut punch if the market drops a bunch right after you reallocate. So again, that's one that we would be comfortable doing in a more, kind of a methodical approach possibly, right? But really the key with this is, again, assessing, what your goals are, what investment return you need to hit those goals, as well as what your risk tolerance is and comfort level, and coming up with that intersection on how to be allocated, both now and then at the time of retirement and a path to get there. And then coming up with a plan, over the coming period, how to allocate your current balance, how to allocate new contributions to best address that and make sure your money's working for you in the most appropriate way. So for those that are over allocated to stock and you're saying, gosh, Dave, I hear you where maybe I'm too growth allocated, but the market's down, nearly 20% last year. I don't want to sell at a low. Again, this chart right here shows the last 15 months, a year and a quarter. You could see the market's still down a bunch from where it was at the start of the period, right? And so, a lot of folks are saying, well, I'm going to wait till the market comes back, right? I'd say the flip side of that is that if you look at the last 5 years, for example, not the last year and a quarter, you could see from the red circle to the green circle, the stock market, the S&P 500 is up over 70% over those 5 years. That's an average 11.5% return per year. Not to mention the prior 5 years was good as well. And so while it feels like a hole and you may not want to sell low, right, or feel like you are, when you look at a little bit of a longer lens, you're actually up quite a bit, most likely in your stock investments over the last handful of years. And, it could get lower, right? No one knows for sure. Again, like I noted in that first couple slides, there's a lot going on right now. And so again, talk to us about it. Don't just log on. I hope you're not logging on right now and just kind of, shooting from the hip and selling a couple 100,000 of stable value or 100,000 of, S&P 500. Contact our office. Let's talk about it and come up with a plan. But I would say when you look at a little bit of a longer lens, the stock market actually has experienced nice growth over the last 5 years, even though the last year has been tough. And by the way, the market's a good chunk higher than it was at the lows of last September too, double digits higher. So may not be a bad time to start, rebalancing your portfolio to the right mixture, even if you are over allocated that growth bucket potentially, and a little, tentative to sell. All right. So that goes over personalizing your investment portfolio, your investment risk to your own goals and needs, again, which is, really the number one thing to be doing. The next couple sections here we're going to go into is how do you build an all-weather portfolio that is equipped to handle, the environment that we're approaching, no matter what that environment may be. And the number one thing to mention there is diversification, right? So to be properly diversified. And so there's a couple common problem areas we see in working with Boeing employees. First one being, if you have too much concentration in one stock, that could sink the ship, right? when you own one company stock, you are dealing with company specific risk that you are able to diversify out of by holding a basket of diverse stock funds, right? Like a index fund, for example, or an ETF fund. And so if you have too much concentration in one stock, like we saw with Boeing, anything can happen. GE used to be the class of companies, right? They were a strong performer year after year. If you look at what happened to, shareholders there, a massive amount of wealth has really evaporated from that holding. And I don't know if that's going to recover, right? GE is a very different company than it was a couple of decades ago. We see it a lot with Boeing, right? You work at Boeing, you've seen the company, you feel like you may have, a little bit of an insider view in terms of, what the company's prospects are, what you're working on. And so commonly we'll see folks with a large holding in Boeing. One, you already have a lot of, exposure through your paycheck, right, to Boeing in terms of making sure they continue to pay you, not to mention your pension down the road. So you already have a lot of exposure there. But two, there's a lot of risk. I know Boeing stock was over $400 a share at one point. Now it's a bit over 200 years later, right? And so here we are. It's still half of what it was at one point. I hear this really commonly. Well, once Boeing gets back to 300 or 400, I'll start selling shares then. Yeah, good chance Boeing gets back to 300 or $400 a share. It might take a long time, right? And even if it does get back there, who's to say that other stock market investments won't get there quicker, right? The market has priced today what they expect Boeing to do and what its prospects are. And that's based on the overall macro environment. That's based on current management. That's based on the latest financials and, kind of new planes coming to launch and orders and you name it. This information is all out there, and you have teams of analysts reading every financial statement and sifting through that, which has determined the price today. And so, yeah, there's a good chance Boeing does well, but there's a chance it struggles, right? It could be at $200 in 5 years, who knows? And so whether it's Boeing or Microsoft stock or you name it, having too much concentration in one stock can take you off a good path very quickly. Being too aggressive or too conservative, like we hit on the other slide, is another problem, right? And may keep you from hitting your goals. And then the other one that we see a lot is not all bonds are created equal. For example, we ran into a client that had, a good chunk in bonds, right? They had 600,000 or so in bonds, but they were all in high yield bonds, which are, much lower quality than government bonds or AAA rated bonds. And those will act like stocks quite a bit. And those are a lot of companies that have to pay a premium or higher interest rate to borrow money because there's more risk that they're able to pay that back. So you could see real losses in those type of bonds. Just because it's a bond and it has it in the name does not mean that fits into that real, conservative, bucket that I was hitting on, that you're going to want to rely on for short-term draws and retirement. Likewise, bond index fund got hammered last year. Gosh, it was down, 13, 14%. Supposed to be a safe fund, but in this environment with interest rates going up so quickly, that really took its toll. And so we do believe when investing in bond funds, matching the bonds we're using to your picture to really manage interest rate risk is a big one as well. As I noted on the prior, slide there, how to think about bond investments is a critical component. We've all heard the adage, when interest rates go up, bonds go down. And so really thinking about that and matching it to your own retirement needs is critical. The way that I, commonly think about it, and we do for our clients, is that, we want to match your investments to when you need the money. And so if you need money in the next 1, 2, 3, 5 years for retirement draws, probably shouldn't put all that in a 30-year government bond. By the way, 30-year government bonds were down about 30% last year with interest rates going up, right? Which is pretty darn dramatic. And so again, by matching your bond portfolio, your income portfolio to when you need the funds and matching, the term of those bonds is really critical. Stable value bond is very short term. Bond index fund is a little bit longer term. And so it's finding the right blend that meets your needs. And so, that's another one that really important to personalize to your portfolio what your income portfolio looks like, right? It's not just purely have this amount in bonds. It's which bonds do you have, where do you draw from, how do you rebalance those, which is really crucial to do as you're preparing for retirement. Another component is investing for inflation, right? As I noted earlier, 40-year highs in inflation we hit last year, and while that's come down quite a bit, we're still dealing with around 6% inflation. I think there's a lot of maybe putting the cart ahead of the horse a little bit, where there's an expectation that inflation is going to neatly come right back to 2.5%. Time will tell. There's an absolute case where it's a lot harder to go from 6% to 2% than 10% to 6%, and especially in this environment that we're in. And so, there is a risk that we might deal with higher than, goal inflation for the next number of years. And having a portfolio that's prepared for that is really paramount in our view. Fortunately, we have a couple of tools to really deal with prolonged inflation. One, like I noted, in your bond portfolio, using short-term bonds as well as mixing in inflation-linked bonds is a really great combination. What's neat about inflation-linked bonds is they're going to act like normal government bond funds. However, if inflation's higher than which is currently expected, which, by the way, right now the market expects inflation to get back to about 2.5% in the next 5 years. If it comes out higher than that, inflation-linked bonds will pay you a higher premium, right? So you're going to earn more on top of that. So that acts as a partial inflation hedge. In addition, real assets, having commodity exposure, having precious metal exposure is really important in this type of environment where we may be dealing with high inflation for a while. We know the government in the US has 30 plus trillion in debt. They're paying $1 trillion plus each year just for the interest on that debt. It's expected that we could see those levels hit 50 trillion by the turn of the decade. And so that's a lot of money printing, right? And really watering down the dollar. And so having real asset exposure, as it did in the 1970s, can be a really critical hedge for your portfolio. And then certain stocks will do better in a high inflation environment, energy stocks, value, strong cash flow stocks. And so having that right blend there. From 2010 to about 2020, technology stocks, the NASDAQ really trumped everything. It's important to have some of that too, but having a nice balanced investment stock portfolio, we think is really critical as we go through this period. The last 40 years, we saw interest rates go, from 20%, essentially to zero. We saw inflation go, from high to very low. Likewise, it's hard to see interest rates going back to zero, right? We have high inflation. It's hard to see inflation going back to, near zero. It's possible. So just being positioned for an environment that looks different from the last 40 years is something that we really think is going to catch a lot of folks by surprise. Just before I turn to the next slide, Boeing does have a real asset investment. It's a little less precise than we'd like to, right? There's a lot going on in there, from inflation-linked bonds to real estate, to you name it. But again, in your brokerage accounts and your IRAs and your Roth IRAs outside of Boeing, there are a lot of tools to use inflation-linked bonds, real assets, commodities, precious metals, things of that liking. So it's something we're happy to talk to you about as well. Okay, and then the other environment we also got to be prepared for is investing for a recession, right? Like we hit on this past quarter, earnings came down from prior. There's a lot of belief out there that, to see inflation really tackled, we need to see higher unemployment rates. The way you get higher unemployment rates is usually companies struggling and earnings struggling. And so as there's a lot of headlines out of there, there's absolutely a chance we're going to see a recession in the near term. We know at some point we will. Generally you have a recession every handful of years or so. And so, really having treasuries, quality government bonds that is a thing in your portfolio that historically will do well in a traditional recession, and be supportive, flight to safety if we see the Fed start cutting interest rates. So you want some of that. One reason we like inflation-linked bonds is that those, like treasuries, can be supportive in a recessionary environment. They may underperform treasuries a bit if you have deflation, for example. However, those can really kill two birds with one stone, right? Where it's braced for an inflationary environment, but also braced for a recession, and that kind of classic stagflation environment that everyone's so worried about. Inflation-linked government bonds could be a nice tool there as well. You may be feeling like this point, like you got a fire hose to the face, right? As I'm rattling through these. But it's important just to make sure you do have that all-weather portfolio, especially approaching retirement. And really what we want to avoid is that you are too vulnerable in one area or another, right? Technology stocks were down over 30% last year. People that were overexposed to that, really had a hard time, especially if you're retired. Long-term, long-duration bonds got hammered last year. Same thing. We'll see what happens this coming year, but having a positioning where you're able to weather, whatever is ahead is really crucial in what we really focus on for our clients. And it's very critical once you go into retirement and you're pulling money out rather than contributing and saving, right? So again, as we get into in the slides, if you take us up on that complimentary review, we will look at this in your portfolio and provide feedback on that, and make sure to help you be positioned the right way. Okay, and so, sort of the next portion here, investing with tax savings in mind. So maximizing for taxes is huge. And remember, taxes is part of your net performance. And it's something that's in your control. And so with investing, really what matters is what's going to end up in your wallet. What's your bottom line return, right? And so if you're overpaying in taxes and investing in an inefficient way, you might be earning a higher headline return. But if really what's going into your wallet in net of taxes is a much lower amount, that's what matters at the end of the day. And what's great about taxes, and we do this for our clients, is that by having a tax planning strategy that includes a longer term plan as well as a short term plan on how to implement, this is something that you control and can get tax alpha, right? Get additional money in your wallet today and over the long term by managing your taxes. And so we're really big on with our clients having a proactive long-term tax plan, as well as each year running a tax projection and having in place activities and tasks we need to do to implement that plan and save on taxes. And so we're going to go through a couple slides on investment strategies that will increase your bottom line and help you save on taxes. A real important one that gets overlooked all the time is investment location. And so really when we think about investing in the different buckets for tax purposes, it really falls into three main categories. The first one is your tax deferred accounts. This is your traditional IRA 401k money, your lump sum money, if you take the lump sum, where basically money in this bucket, you don't pay tax on it while it's in there. But when you pull draws out, when you pull your money out, every dollar is taxed as ordinary income. Likewise, your pension and Social Security are taxed as ordinary income as well. For most people, 85% of your Social Security income is taxed as ordinary income for federal purposes. The second bucket is your tax-free bucket. This is your Roth 401k, money that you contribute to your Boeing 401k after tax and convert to Roth. You have already paid money or tax on this money, and all the future growth and current income is tax-free. So this is a great bucket to have and provides a massive amount of flexibility. And then the last bucket is your after tax. So this is your non-retirement investment account, your brokerage account, savings, money market, CD. And with this, your principal has already been taxed. So it's only the dividends and interest for the most part that are taxable, as well as the gains when you realize or sell something. And so really the key here is that you want a combination of these three buckets that gives you a lot of flexibility, and you want to be investing your money the right way across the three. For example, in that Roth tax-free bucket, that's a great place to have your growth investments because all the growth you never pay tax on. On the opposite end, your tax-deferred account, your traditional IRA 401k, great place for high interest, high dividend investments. You don't pay tax on that interest and income and dividends when it occurs, but all the growth when it comes out can be taxed as ordinary income. So if you're going to double or triple an account in the next 15 years, for example, you'd rather do it in the Roth account where you don't pay tax on any of the growth versus your tax deferred traditional IRA 401k, where when the money comes out, whether it's you or your heirs, every dollar is taxed as ordinary income. Likewise, with the new Secure Act that came out, that's really impacted on how your children, your beneficiaries will receive their inherited accounts from you. And it makes it much more tricky with those tax deferred IRA 401ks on how to do that without them really getting hurt by taxes. And so again, by being thoughtful on where to invest what funds in which manner is a big deal. And then likewise, at after tax, your brokerage account, that's a good place to have growth investments as well. You only pay tax on the gains when you sell something and you realize it. And that's generally at a lower tax rate, capital gains tax, rather than ordinary income. We still have what's called a step up in tax basis. In Washington state, if either spouse passes, you get a full step up. All the taxes are wiped out basically, and the gains are wiped out from a tax perspective on those investments. So you could hold long-term growth stock investments in a brokerage account, and potentially your family will never pay tax on it. Short-term funds, that's a good place to put it in your after-tax bucket, your non-retirement account. Money that you need for emergency fund, short-term, purchases, things of that nature. And then you could also use tax-exempt bonds like municipal bonds here, but you want to be really thoughtful of that. This is something I commonly see misused, where folks may not get the benefit of a municipal bond depending on their tax rate, potentially. But that's a good place to hold those generally. You don't want to hold that in a tax-deferred account, for example. And so this is something that we really focus on with clients. So in those earlier slides, number one objective, right? Make sure you have the right amount of risk. We're being thoughtful about taking retirement income, making sure you have the right amount of growth, right amount of income portfolio. And then from there, it's, okay, where do we hold our growth investments? Where do we hold our income investments? So we're really able to maximize, our net return after taxes. So this is a really critical thing to do as well. Okay, next item is we want to invest with an eye on taxes as well. And that includes planning your retirement and your investment strategy with what your future tax picture will be in addition to your tax picture today. An example of this is in 2026, we know the tax rates are set to reset. And basically, the current tax rates are going to roll back as of now to the prior regime's taxes, where just about everyone's tax rates are going to go up. For a lot of folks, you're going to go from being in the 24% tax bracket to the 33%. That's nearly a 10% increase. Quite a few people are going to go from 12% to 25%, more than doubling. And so it's important to look at, your current tax rates versus the future. And so that an example of that is you might want to be doing Roth 401k more so, right? Versus a pre-tax 401k, even if you're at the 22 or 24% bracket, based on what you project to be in down the road. Another question mark is, where will there be future state income taxes? If you move in retirement to a state like Arizona or Idaho that has a state income tax, or Oregon, it may be better to put money into your 401k as a Roth and pay the tax now, knowing that in retirement, you're going to be paying a state income tax on top of an ordinary income, federal income tax. Likewise, we'll see what happens in Washington. Recently we had passed a capital gains excise tax. A long-term care tax came into play, as you know, going into effect this year. And I don't know, I think there's a question mark whether we're going to be dealing with more state income taxes, whether that's on ordinary income or a lower threshold where capital gains income is taxed. So again, that's something to be cautious of as well. And it's a little bit bird in hand, right? If you know you're paying a 22 or 24% federal tax without any extra Medicare tax, without state income tax, without additional capital gains tax today, that might be better to swallow the pill now and do that at today's rates, given the unknown on what rate you'll be in the future. And then on top of that, you really want to have nice balance and flexibility going into retirement on those different tax buckets we covered on the prior slide. We see it time and time again where folks will contribute to their, pre-tax traditional 401k at Boeing. You get your lump sum or pension, right? So whenever that money is used, it's taxed as ordinary income. Social Security's taxed as ordinary income. And so commonly, someone may have a couple $1,000,000 saved between their 401k and lump sum, all pre-tax. And so if you have a big house expense come up in retirement, or you need purchase a new car, or something unexpected happens, you're going to access funds, and it may put you in a much higher tax rate because you don't have any Roth money or non-retirement brokerage money. And so those years leading up to retirement, coming up with a proactive game plan to get that flexibility at favorable tax rates, so you have that retirement flexibility down the road, is something really critical, which we're really dialed in and working with our clients on. Yep, and then last slide on this, tax efficient investing. This is specifically in non-retirement investment accounts. By investing in the wrong fund type in the wrong location, it is very common where you may lag your return by 2% a year just based on fund expense and tax efficiency. And so right off the bat, on January 1st, you're in an inefficient investment in a taxable account that's costing you 2% a year in return or more, no matter what the performance of the fund is. That is a massive, basically headwind to overcome. So a couple of things. We love using exchange traded funds, ETF funds, and non-retirement brokerage accounts. These are really, well known. It's a $1 trillion industry. They're very tax efficient, very low expense. And so these are great tools where you could get very precise on your investments and do it in a tax advantaged way. Municipal bonds, as I noted on the prior slide, can be very effective on a case-by-case basis. When investing in a municipal bond in a taxable account, those are exempt from federal income taxes. However, they generally pay a lower yield for that reason. So if someone's generally in the 24% or lower ordinary income tax rate, we don't typically see an advantage to using municipal bonds. Plus, they don't have the same credit quality as treasuries, right? So in some cases, if you're in a higher tax bracket or in a really high income year, you may want to use those. Or if you're trying to manage your income to a lower level to keep your Medicare premiums down or something of that nature. Although Medicare premiums do look at that interest as well, but in general, there's some cases where that might make sense. In a lot of cases, it's better to use traditional bonds to get the higher yield and more kind of a wider universe of options to choose from. And then here's another one. I mentioned real assets and inflation-linked bonds are really great investment tools to sprinkle in to protect for inflation. You got to be really careful in taxable accounts. If using correctly, for example, precious metals, you pay a higher capital gains tax rate. Real assets, a lot of commodity funds create really high dividends and taxable distributions each year. So, commonly we like to use those investments in your tax deferred accounts. But again, something you got to be thoughtful on when investing there too. Yeah, well, I hope you found this content helpful. I know we covered a lot of ground, but again, it's so critical, especially as you're approaching retirement, to be doing everything in your power and make sure you're not taking any missteps that can put you on a bad course. So again, all this information is really helpful, or we hope we found this very helpful. Um, take us up on a free second opinion where we'll look at your investments and retirement plan. As a benefit for you for joining this webinar, we are happy to offer that to you. And so I'd say, especially anyone within 3 years of retirement, take our office up on this. You'll have a chance to meet with one of our certified financial planners, and we'll review those key financial decisions and investment allocation, specific to your own personal financial picture. Contact our office to schedule this. You can reach us at 425-646-6327 or send us an email at info@stablerwm.com. But again, while these are big decisions, the good news is you don't have to go it alone, right? Even though this is your first time retiring, working with offices like us, this is what we do on a daily basis. And so it's nice to have a partner making all these decisions. You've come along this far, right? And so you want to make sure you don't take any missteps in retirement. I'd say another good way to set up the session is you could just hop on our website right now. To go to the quick page, go to www.planyourboeingretirement.com. Click on Let's Get Started at the bottom of the page, and that will take you right to a form where you could send us a couple sentences about you, what's with your personal situation, some things that you want to make sure to address, and we'll get a meeting on the calendar to give you that, complimentary financial review. So yeah, hop on the website right now today. Take advantage of this. We'd love to meet with you and provide you a second opinion and some feedback on your financial picture and some suggestions that we would make. Well, I hope you found this content helpful. As we've been doing regularly, we're going to continue to hold these Boeing seminars and webinars on a ongoing basis. And so therefore, if there's any topics you'd like us to cover that we haven't hit on yet, please send us an email, reach out to us on our website. We'd love to get your feedback to make sure we're covering those topics that are most important to you. Likewise, please extend these invitations to your colleagues. This is how we get introduced to other folks. In addition to reaching out to us, pass this on to other people. We'd be happy to add anybody to our communications list. So send us a name of anyone that wants to start getting this content as well. We'll keep sending out emails of great articles and webinars and video events, and we'll post all this on our website too at planyourboeingretirement.com. So please provide your feedback. We'd love to hear from you on topics and feedback on how we can continue to make these presentations helpful for you. And and we thank you again for your time, and we look forward to catching you at the next one as well. So appreciate you, and look forward to hearing from you soon. Take care.